So the loanable fund market is where the supply of loanable funds and the demand for loanable funds come together. So these are the people who put their money in the banks, and the banks want to loan it out, and they're seeking interest. These are the demanders of loanable funds who want to borrow, and they want to do that at low interest. So where they meet and come up with a price is called the real interest rate. That's the nominal interest rate adjusted for inflation. So the real interest rate is going to tell us, or be the price of borrowing. So the quantity of loans that's demanded and supplied will meet and have an equilibrium in voluntary exchange, just like any other kind of market. So there we have the quantity of loanable funds. Now, how much investment is done at each interest rate gives us the investment demand curve. So the investment demand is the people out there that want to borrow money. And that'll tell us how much gross private investment is done at each interest rate. So the real interest rate is going to show us interest-sensitive consumption. So this real interest rate, if I go over here and bounce it off of investment demand, that's going to give us this much investment. Remember, that's buying capital for your tools, your machines, things for your business, things that lead to economic growth. Okay, so we'll have this much interest at this interest rate. Now, if the supply of loanable funds were to increase, as in people decide not to hold cash and they put it in the bank, or people make deposits, or however you want to look at it. Okay, so if the supply of loanable funds were to increase, that means it would be a shift to the right. That means there's more money in the bank for the banks to loan out. So I shift it to the right. I have my right arrow indicating that. Now, the demand for loanable funds, people going to the bank and asking for money, or the supply of bonds, needing to borrow out of the public sector. Where that crosses, we're going to have a new interest rate. So I'd see that the real interest rate would be lower when there's more supply of loanable funds. So the quantity of loanable funds out there has been increased, the supply has increased. So I see that there's a real interest rate drop. Now, what's that going to do for investment? Well, let's bounce this over, reflect off, and see that I do get more investment at a lower interest rate. And that would lead to aggregate demand going up, then GDP going up, inflation going up, price level, all this stuff on that investment or aggregate supply and demand curve. Now, if the supply of loanable funds were to decrease, as in the United States government decides to borrow and crowd us out, I'm going to draw this on the same graph, but you don't have to. It's just so you can see the difference in the two. So the supply of loanable funds were to decrease. It would shift to the left. Now there's the same amount of demanders out there, but now there's less money. So anytime there's less of something and the same demand, we have a shortage. And that would make the price go up. So that'll cause the real interest rate to increase. So at higher interest rates, if I draw this over here, bounce it off, reflect it down, at high interest, I can see there is a reduction in the amount of investment done, or interest-sensitive consumption, buying of tools, capital, stuff like that for businesses. So investment would decrease if there's a decrease in the supply of loanable funds. Then off of that, you can do a bunch of different things as far as graphs you could draw.